Hello everyone, my name is Siddharth Shrivastava and I am Head ETF Product and Fund Manager at Mirae Asset Mutual Fund. In this video, I'll be giving update and outlook on passive funds, domestic markets, precious metals and international markets as well. First, the passive market update. The strong momentum in passive market continued in 2025 with AUM reaching 13.7 lakh crores as of November 2025. Passive schemes now account for almost 17% of total mutual fund industry AUM, up from just 9% in November 2020. The number of passive schemes in India has grown to 649, offering investors greater choice and diversification. Passive inflows remained robust at 1.33 lakh crores over past 1 year. Additionally, ETF market liquidity in India has strengthened significantly, with average daily traded volume rising to almost 2,400 crores in 2025, up from just 1,500 crores in 2024 and just 250 crores in 2020, reflecting deeper participation and improved price efficiency. Now the domestic market update. A key contributor to the slowdown in Indian equity markets during 2025 was a prolonged and broad-based earnings downgrade cycle, which dampened sentiments and valuations through much of the year. Quarterly results through FY25 and early FY26 consistently fell short of initial expectations, leading to sequential cuts to forward earnings across multiple quarters. Encouragingly, the intensity of earnings downgrade has moderated now. The bulk of the earning resets appear to be behind us, setting the stage for a more stable and potentially improving earnings environment going forward. As earnings visibility improves, market performance is likely to transition towards an earnings-driven recovery over the next year. Earnings recovery is going to be the most important factor for Indian markets in 2026. In an environment marked by improving earnings visibility and a gradual recovery in consumption, new age consumption themes offer targeted exposure to demand revival in discretionary consumption, services, and emerging lifestyle categories. Financial services remain well positioned to benefit from BFSI-led earning upcycle, supported by credit growth, improving asset quality, and operating leverages. Within broad-based equity, a multi-cap allocation appears better suited for 2026. This approach allows participation across large, mid, and small cap segments and helps capture a broad-based earning recovery as market recovery potentially widens. In smart beta space, given the absence of a strong, persistent market trend currently, a diversified factor approach is preferable at the current juncture. Factor strategies such as alpha and momentum may continue to relatively give subdued performance in the initial phase of the cycle, although volatility is expected to be lower compared to CY 2025. Now gold and silver outlook. Both gold and silver has run up sharply in 2025. While it is difficult to call out the top, one can expect returns to moderate significantly. We expect silver to have higher drawdown risk than gold, as gold may find support from central banks at lower level. A gradual tilt towards gold may be warranted if the silver rally shows sign of exhaustion in order to manage risk with an intent to book profits after this historical rally. Any fresh investments should now be ready for higher volatility, should come for longer horizon, and seek to avoid excessive allocation at this stage. Now moving on to China, we remain optimistic on Chinese equities for 2026, but prefer some segments more than the other. While the broader market continues to face headwinds related to property normalization and pace of consumption recovery, our conviction remains higher in Chinese technology and innovation-linked companies where earning visibility is stronger and growth is less directly dependent on domestic demand cycles. Valuations, policy direction, and improving earning dynamics argues for participation in Chinese markets. However, China's risk asymmetry remains unique. Periodic regulatory shift, external trade frictions, and geopolitical issues can still reset sentiment abruptly. As such, aggressive overallocation should be avoided. A disciplined approach focusing on quality balance sheets, earning visibility, and structural themes finding favor of current policies remain the most appropriate way to engage with China's evolving opportunity set. Now on to US market outlook. Corporate earnings remained a key anchor for US equities throughout 2025, with quarterly results consistently exceeding expectations. Over the course of the year, the S&P 500 delivered 4 consecutive quarters of double-digit year-on-year earnings growth. In the most recent reporting season, around 80 to 85% of S&P 500 companies reported earnings above analyst expectations, well above long-term averages. Big techs continue to deliver in spite of higher expectations and concerns on AI spending. Looking ahead to 2026, the outlook for US equities remains constructive. Corporate earnings are expected to remain a key anchor for the market in 2026. Market corrections, if any, are therefore likely to present selective opportunities for long-term investors rather than signal a fundamental deterioration in the equity outlook. We continue to remain positive on big tech and segments like AI and AI infrastructure. We may see a broader participation across sectors and market cap segments in 2026. US equities remain well placed to deliver reasonable compounding for disciplined long-term investors. Please visit our website for detailed outlook on the above markets. Thank you for watching this video. Wish you a very happy new year and happy investing.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.